Hello, welcome to my course on Introduction to Dividend Reinvestment Plans, which are known as DRIPs. DRIPs are defined as a dividend reinvestment plans, such as a stock that pays out dividends, are usually reinvested to take advantage of the power of compound interest. So basically, you get a stock, it pays a $5 dividend, stock is selling for $10, so you get a half a share, so you get a fractional share that's reinvested. Now, the benefits of a DRIP plan is dollar cost averaging, which is very efficient since plans usually have no fees or they're extremely small compared to a discount broker. The fees usually break down to like $1 or $2 compared to your discount broker, which will charge you between $5 and $12. But usually the fees are non-existent in most cases. Dividend reinvestment plans forces you to save over time, and little investments as low as $25 can be done. So, dividends will compound over time if reinvested, as well as the company growth of the dividend through increases from the company. Now, some DRIPs might offer a discount from the spot price from the market as little as 1% and up to 10%. Now, you have optional cash purchases. They're usually free, or they're up to $2.50 in most cases. Like a lot of large blue chip companies may tend to have it fee free, but in some areas, like Coca-Cola, might have a $2 fee for automatic investment or $3 for optional cash purchases. Also, we got automatic purchases that can be monthly or bi-monthly and are usually free, or they have a very small fee, like $1. Like Clorox Company has a monthly or a bi-monthly payment plan. So when you invest, so you can invest like $50 on the 1st and the 15th, and it's no fees. But Coca-Cola has the same idea. You can invest $50 on the 1st or 15th, but they charge like $1 or $2 for that service. Usually there's no fees to reinvest dividends. In most plans I've examined, there's usually no fees. But in some cases like Coca-Cola Company will have a 5% of your dividend fee, but the maximum fee is like $2 or $3. Now, this is a very cost-effective way to invest because you can send off a $50 check or ACH transfer to your transfer agent to buy the shares, and you can get fractional shares, as well as your dividends that reinvest. You can get fractional shares, so that takes the power of the compound interest as well as the growth advantages of a stock. Now, you save more money by investing more money because you're having the brokerage commissions fees cut out. Now, you can invest in the market at your own pace by investing as little as, say, $25 or up to $100,000 in a particular plan. Finally, the investor can build a diversified portfolio on a budget. So pretty much you can pick 6 companies that pay decent dividends and good cash flow and growth. You can put like $50 a month for each one of them, and so over 10 years, you'll have a nice sized portfolio as well as very well diversified against market risk. Now, the DRIP disadvantages are selling fees are usually high. They're between $15 to $25 to pretty much discourage buying, selling for trading. And the transfer agents are usually really slow on selling, so they might do a batch sale, and that usually takes a week. Now, the transfer agent buys a stock, usually for that day, like on a daily average, purchase for that day, so there's no specific price point, unlike your discount brokerage where you can lock in a limit order at an X price. Now, the plans tend to do batch purchases. That's why they save so much money on commission fees. Pretty much they buy like once a week, every, say, Tuesday or Friday for optional cash purchases. And an order could take up to 5 to 7 business days to purchase and to put into your DRIP account. Now, keeping track of the cost basis over time if you sell could be a disadvantage due to laws before where the investor had to keep their cost basis. Most people just throw them in an Excel sheet, but under today's new laws, the transfer agent should be able to keep track of the cost basis for you. Now, why do you use a DRIP for the long term? The Dividend Reinvestment Plan basically combines the power of compound interest and the growth rate of a company's stock in their dividends. So, like a company X pays out a 3% dividend, but their dividend growth rate over the past 25 years averages out at 10%. So basically, you're buying more shares over time, but your dividend's constantly growing. So it grows at an exponential rate. So I used an example for consumer staples. During the past 50 years, consumer staples had a 12.9% annualized return. And this would be like ideal for dividend reinvestment plans. Pretty much to hedge against market risk. It's consumer staples, basically people buying everyday products such as Pepsi, Coke, chips, and baby products and other healthcare products. So I put a chart up for an investment if you say yielded 12.9% on average for about 20 years and a compounding period of once a year. So you can tell it goes up to $10,000 with a $1,000 investment. Now I took an 8% case to see the worst case. So for $1,000 invested, we pretty much go up to $4,500, which is not too bad since it's 4.5 times more than your initial investment. Now, why do you want to use consumer staples for DRIPs? Well, you have a large economic moat. That means a high barrier of entry. So that means they have pricing power over their competitors. So the products that everyone needs are not subject to extreme economic cycles because you're going to buy it anyway. And if the costs go up, well, they pass it on to the consumer anyway. So that means they'll increase your dividends over the years. So also, they can invest their capital so they can get a high return on capital to continue paying the dividends and increasing it over the years. Dividends will grow faster than the rate of inflation, so over the longer the time period, the better. Welcome to my course on getting started with dividend reinvestment plans. You basically use a transfer agent. Is the company that administers the stock plan for the dividend reinvestment plans. So basically you get into a plan and you'll see what the company's fee schedule is. For example, we're using the Procter & Gamble fee schedule. There's no setup fee. Optional cash purchases are $2.50. And as you can see, the automatic investment fee is $0. But, you can look at the top. The way to get in here is the initial one-time purchase. And then after that, you can make one-time purchases or ongoing automatic investments over time. So what if you need a share to get started? Sometimes you need a share before you can get into a dividend reinvestment plan. But you can't do it just by an initial buy-in. So there's two methods to get into the program. Is to transfer a share from a friend to you to buy, or to buy a share from a company that sells them as gifts. For example, GiveAshare.com is one of those major companies that does that service. Other companies that sell shares, but there's various names of those companies, so you need to use Google and compare prices. But the most expensive method is to transfer it from your discount broker to the transfer agent, which can cost as much as $500 extra. Thus, it's not worth it. Now, to get started, you need to either do an initial buy-in or a recurring transfer. So all you do is pretty much look at the plan. If you like it, you click like buy now or enroll now. And all you need is a checking account, and the paperwork will tell you from then on to what they need. Hello, this is an extension of my Getting Started lecture with Dividend Reinvestment plans. So we're just going to look at computer share transfer agent and how you actually get started. So you just pretty much click the Investor Center, and if you're an existing user, you log in. But if you're a new user, you click the Buy Stock Direct, to see what you need. And if you know the ticker symbol, just enter it in, or the company name at the top. After that, we look at the fee schedule. And as you see, we've got the initial setup fees right here. But if you like the plan, after you see either a minimum one-time purchase or a minimum automatic investment, you can click Buy Now. If you're an existing user, you just log in. But if you're a new user, you just create a new account. You'll need a checking account and social security number, so that way they can register the shares in your name. So pretty much you go to a company website and you go to this stock firm information, and then you go to the transfer agent page. After that, you know who the transfer agent is, and you just go from there. Thank you. Welcome to my course on how much can I save using DRIP plans. So I'm going to use the $200 a month case for 5 years. So save $200 a month for 60 months with the average consumer staples return dividends reinvested for the past 50 years is 12.9%. So basically we get $200 a month for 5 years. We'll grow to $16,913.61, which is a great start, and it'll be even better in 20 years since dividends will magnify the return over the longer the time period is. So that by that time it'll net you $225,969.35. And this is great if you start at 16. However, most of us are working professionals. We're just getting into the workforce. So basically, the $200 a month plan is pick 4 companies that you invest in 10 to 20 years. It's just basically a starter plan. Invest a minimum, which is usually $50 a month. Pick plans with no fees, since the fees will hurt your yield over a long term with the $50 a month plan, and reinvest all dividends so you can take advantage of compound growth. Now, I did 5 years in the military, so saving $600 a month should be quite easy on a 5-year enlistment. And I highly recommend that you save. The GI Bill doesn't cover some of the months, so dividends will help make life better if you're in that circumstance. Now, if you save about $600 a month for 60 months upon completion, you should have about $50K in savings, assuming a 12.9% average consumer staples return for the past 50 years. However, anything near $50K plus or minus $5K can be a great return. Now, this is what I think about the working professional plan. This is what I'm shooting for as soon as I get my entry-level actuary job. So the example is saving $1,500 a month for 5 years, and then we're going to look at the 10-year future value with continued contributions for every month. So in 5 years, you'll get about $126,800, and a 10-year future value is $367,800. It's great for anyone that just approached the 30s and been in saving for 10 years. This amount of capital will buy you freedom for the rat race in the future, but like the working professionals plan, instead of 4 companies, I highly recommend between 7 and 9 companies as your core holdings. And just put the money in there over the years consistently, and that should make life a lot better. And that's it. Thank you.